Welcome to the webinar, The Investment Case for Advanced Plastic Recycling. My name is Kristen Marshall, Associate Research Director here at Lux Research, and I will be moderating today's session. Presenting today is my colleague Martian Lee, analyst here at Lux. Throughout the webinar, you can type any questions you have in the questions box on your screen. Time permitting, we will answer all the questions that we can. If your question does not get answered, please do not hesitate to email it to us at questions@luxresearchinc.com and we will respond. If at any point you experience any technical difficulties, such as a frozen screen, simply refresh your browser and check that your internet connection is strong. Now, let's jump into today's presentation. Take it away, Martian.
Thanks, Kristen. Good morning, everyone. My name is Martian and I lead Lux's research on advanced plastic recycling. I'm sure many of you here today are familiar with what's often described as the chicken and egg problem in advanced recycling. On the one hand, the industry has been hesitant to invest in large-scale recycling plants without first confirming the availability of feedstock. That's understandable, right? These are capital-intensive projects, and it's very hard to justify that level of investment without confidence in upstream supply. But on the other hand, the waste supply chain has been equally hesitant. There hasn't been much incentive to invest in collecting and aggregating these so-called unrecyclable plastics, things like films, mixed plastics, and other highly contaminated post-consumer waste streams, because there hasn't been a guarantee that the downstream has the physical capacity to take it off their hands. So what we end up with is a kind of a stalemate, right? Each side is waiting for the other to move first. And as a result, progress has been slower than many would have expected. But I would argue that this dynamic is starting to change. If we look at where the industry stands today, there is already about 1.5 million tons of advanced recycling capacity physically installed. And we're on a growth trend. Based on project announcements, advanced plastic recycling capacity is projected to grow to about 4 million tons over the next 3 years. Now, if we assume a feedstock price of about $400 per ton, we are already looking at an addressable market of roughly $600 million annually for waste suppliers today. And these can grow beyond $1 billion by 2028. So we're no longer just talking about theoretical projections, right? This is real capacity, real demand, and a real business emerging in advanced recycling feedstocks. And I think that because we now have physical capacity in place, it starts to create a kind of pool across the value chain with suppliers, aggregators, and even logistics players starting to align and respond to the needs of the advanced recyclers. Additionally, I would like to also note that this momentum is also being driven and reinforced by regulations. Specifically, we are looking at pressure coming from policies such as recycled content mandates popping up from across the various regions. In Europe, for example, the first set of recycled content mandates is scheduled to take effect in about 4 years. Mechanical recycling can meet the demand from some of these early mandates, but as these targets become more ambitious and expand beyond just plastic packaging, it becomes clear that mechanical recycling alone will not suffice. And that's where advanced recycling comes in, not as a replacement, but as a necessary complement to mechanical recycling. So the question for many on the line today is now the right time to invest in advanced plastic recycling? If we were to think back to the beginning of the decade, many of us would indeed say no. But given that we're beginning to see some of the inertia across the broader value chain being overcome, I think that it is a good time to reconsider our positions. Furthermore, in many ways, we are in a stronger position to answer this question today because we now have the benefit of hindsight. We have learnings from the challenges and missteps of early movers, whether that's around feedstock sourcing, operational issues, business models, or economics. So, using these learnings for the remainder of the presentation, I'm going to set out to evaluate the investment case for advanced plastic recycling. First, I will introduce Lux's methodology for determining the risk and return of an investment in a first-of-a-kind advanced recycling plant. Then I'll use this model to explore different scenarios and determine how future developments particularly those around policy and infrastructure, influence that investment case. And finally, I'll wrap up with some key conclusions and outlooks, including what is needed for the investment case to make sense. Let's begin with calculating the risk and return for a first-of-a-kind project. And for today, we're going to use plastic pyrolysis as an investment for evaluating, as an example for evaluating our investment case. So to do this, we are going to start by calculating the internal rate of return and risk. And just so that we are all speaking the same language, internal rate of return, or IRR, is a measure of the projected financial attractiveness of the plant. It tells us, based on a set of assumptions, what sort of return we can expect to earn over a period of time. Basically answers the question, if this investment performs as expected, how attractive is the payoff going to be? And then risk answers a different question. It asks, how confident are we that those expected results will actually happen? And if not, how far away are we going to land? It is about the uncertainty behind the numbers. So a simple way to think about it is IRR measures the potential return, while risk shows us how reliable that return is going to be. Now, to actually calculate the rate of return, we need to know a few numbers like CapEx and OpEx. And the good news is that as next movers, we have the advantage of access to real plant data. These are not just estimates or projections, but verifiable data backed by actual plant construction and operations. Now, not all of it is public, and even if it's available, not all of it is going to be complete. But I think there is enough for us to form a reasonably solid benchmark. And that's a big step forward because instead of relying purely on theoretical models and projections, we can now ground some of our assumptions in real-world performance. So using this data, we can estimate things like plant size, CapEx, and OpEx for a typical plastic pyrolysis plant with a fair degree of confidence. These parts are relatively straightforward, but there is one key variable that remains uncertain, and that is the product price. Here, we're not talking about the cost of production, but more specifically, how much can we actually sell pyrolysis oil for? And as we'll see, this turns out to be one of the most critical drivers of the entire investment case. One way to go about thinking about this is how the market is willing to pay for pyrolysis oil is to look at historical naphtha pricing. Naphtha prices are currently fluctuating by the day, but if we assume that pyrolysis oil is sold at parity at the ballpark naphtha price of about $877 per ton, what we find is that the project will not even break even, right? We will absorb an annual loss of almost $1 million. Now, if we were to take a more optimistic view, for example, projecting naphtha prices under a higher oil price scenario, say around $200 per barrel, we will start operating profitably. We might start to see internal rates of return in the range of about 7 to 8%. Interestingly, this estimate of about $1,500 per ton of naphtha aligns quite closely with what we've heard refiners may be willing to pay for pyrolysis oil. So on paper, this starts to look like a somewhat viable business case. That is, if off-takers are willing to pay this price over the long term. But as we all know, these prices are single data points, and naphtha prices have ranged from as low as $140 per ton all the way to about $1,080 per ton in the past 10 years. So if we expect to operate our advanced recycling plants for over 20 years or so, this variability must be accounted for. And that brings us to risk, the second part of our model. As Thomas Jefferson once said, with great risk comes great reward, but we also want to be able to determine if this trade-off is going to be worth it. And for emerging technologies like advanced plastic recycling, this is where the analysis can become much more complex. Broadly speaking, there are two major sources of uncertainty that we need to consider that determine how much variability we can expect in our internal rate of return projections. The first is uncertainty in plant economics, right? This is inherent in large CapEx projects where costs can vary significantly. Even for a mature technology, unexpected costs or even savings can always pop up. I think this is quite straightforward, and we can always work with some rule of thumb estimates to start. Now, the second uncertainty, the second source of uncertainty that you may not have considered before is in innovation maturity. How ready is the entire value chain for advanced plastic recycling as a business? Innovation maturity is a bit less straightforward than the first risk, so let's dig a bit deeper into what goes into this a bit more. At Lux, when we assess innovation maturity, we take a holistic view through our 5 factors for innovation success: market organization, market readiness, product, production, and technology readiness. Based on these 5 dimensions, we assign a level of maturity ranging from low to high. And depending on this range, it results in a corresponding modification to the uncertainty, ranging from no change to a 20% increase that we assign to CapEx, OpEx, and or the product price. And just to be clear, these are going to be percentage changes to the base uncertainty plant economics, which we have already established in an earlier step. So what does innovation maturity look like for plastic pyrolysis? Starting with organizational readiness, we are looking at the supporting regulatory frameworks and the status of the supply chains. With regards to regulations, they are still evolving. In most regions, they are close to being formalized, but they're not yet fully established. With regards to the supply chain, it is still developing in the nascent stages. So while we are starting to see some level of alignment, much of it is also still in the early stages. So from a conservative standpoint, I would rate organizational readiness as low. And because of this, we assign 20% greater uncertainty in OpEx because operating costs are more likely to fluctuate in an immature ecosystem. Moving on to market readiness, we want to know if there's a large enough market for plastic pyrolysis oil to make good business. Here, the picture is slightly different. Pyrolysis oil has the potential to serve a very large market that's essentially as large as snuff does, which is worth hundreds of billions of dollars annually. However, the current demand for pyrolysis oil is still largely driven by the expectation that plastic pyrolysis will become widely accepted as a form of recycling, and that the downstream markets will increasingly demand pyrolysis oil to fulfill their recycled content obligations. But again, this is not yet fully established. So I would classify this maturity as medium. And as a result, we will increase the uncertainty in pyrolysis oil prices by about 10%, reflecting the fact that market adoption is still evolving. Now, let's look at product readiness. We want to measure how familiar the value chain is with pyrolysis oil. Pyrolysis oil as a product is already well understood. We know its properties, we understand how it can be used in existing refinery and petrochemical processes. However, the challenge lies in consistency. Specifications can vary significantly depending on the process, the feedstock, and the operator. In practice, pyrolysis oil that is suitable for one refiner may require additional post-processing before it can be used by another. Because there is no universally accepted standard for pyrolysis oil today, this creates additional complexity for buyers. So from a maturity standpoint, I would classify product readiness as medium instead of high. And this translates into a slight increase again in uncertainty for product price. Next, we consider production readiness. We want to know if we are able to physically build the advanced recycling facility, right? And this is actually one of the stronger areas for plastic pyrolysis. We already have a meaningful amount of installed capacity, which is around 850,000 tons per year at the moment. And it proves that we have the capability to design, build, and operate these plants. So from an engineering and construction perspective, this is relatively mature. And as a result, we don't apply any additional uncertainty in this dimension because the industry has already shown that it can execute these projects, even if there are still areas for improvement. Finally, we look at technology readiness. Has the technology proven itself in operational environments? Now, this is sometimes debated because we have seen both successes and failures at scale. But overall, given that there are operators such as ExxonMobil that have demonstrated successful ramp-up in operation, we can reasonably consider pyrolysis to be at a high level of technology maturity. So again, we do not add additional uncertainty here. Now, when we bring all of this together, we now have our key inputs, right? We have CapEx, OpEx, and pyrolysis oil pricing, along with the uncertainty margins for each of these parameters. For the base pyrolysis oil prices, I started by estimating the 10-year average value and uncertainty of virgin naphtha before taking into account the impacts of innovation maturity. And this gives us the data that we need to run Monte Carlo simulations to model a distribution of outcomes rather than rely on a single point estimate. We essentially took a random sample within the uncertainty margins for each input parameter, calculated the resulting IRR, and repeated this process a couple of thousand times to obtain an average IRR and its variability. And based on this analysis, the conclusion is quite clear, right? Under current base case assumptions, the investment case for plastic pyrolysis is relatively weak with a negative expected IRR. Now, we can stop here, call it a day, and just dismiss plastic pyrolysis as unviable, but I would say that this is not the end of the story. And that is because the future will not look exactly like today, and that is where scenario building comes in. Scenario building allows us to explore how different developments, and particularly those outside of our direct control, can influence the investment case. And for this analysis, there are three key scenarios that I'm going to highlight. Firstly, feedstock supply infrastructure. Next, recycled content mandates. And finally, mass balancing rules. In the first scenario, we consider developments in feedstock supply infrastructure. Feedstock availability has been one of the central challenges in scaling advanced plastic recycling. And while these technologies are designed to process low-value, unrecyclable plastics, the reality is that the aggregated supply of these materials is still limited in the near term. Because of these, feedstock costs can be relatively high, and in some cases, operators need to invest in additional pretreatment or work with third-party partners to prepare feedstock to the required specifications. However, over time, we expect this to improve. Collection systems will become more efficient, sorting technologies will continue to advance, and waste suppliers will ultimately become familiar with what advanced recyclers actually need in their feedstock. All of these should increase availability and improve quality, ultimately reducing feedstock costs in the long run. So in this scenario, we model that feedstock costs will reduce by 25%. We also assume that OpEx uncertainty decreases slightly because supply becomes more stable and more predictable. Now, intuitively, this sounds like it should have a significant impact, right? Lower costs should mean higher profitability, but when we actually run the model, the results is somewhat surprising. The expected IRR changes by very little. Yes, operating costs go down, annual profitability improves, but the overall investment case does not fundamentally shift. And the reason for this is quite simple. And it is because CapEx dominates the economics of the project. So even a meaningful reduction in feedstock cost does not really move the needle as much as we might expect. The second scenario looks at the impact of recycled content mandates. Here, we assume that these mandates effectively increase the prices of pyrolysis oil. Additionally, because producers are now required to incorporate recycled content, demand becomes less price sensitive. In other words, they need to buy it regardless of the cost. And it creates a kind of a price floor in the market. In our model, we assume that pyrolysis oil can be sold for up to 3 times the price of virgin naphtha. Now, this may sound aggressive, but it is not purely theoretical. We have already seen cases where companies are paying significant premiums for chemically recycled materials in order to meet their sustainability targets. So this assumption actually reflects a behavior that is already emerging in the market. And when we adjust the product price accordingly in our model, the results changes quite dramatically. Here, the estimated pyrolysis oil comes up to around $1,700 per ton. And this is actually well within the range that has been discussed in industry conversations before. And under this scenario, the expected internal rate of return increases to around 17%. And this is quite interesting because a double-digit return is when investment cases start to become genuinely attractive. But there is trade-off. While the higher product prices improve returns, they also increase the project's exposure to pyrolysis oil price volatility. So what we see here is a shift, right, where the investment case becomes more compelling from an IRR perspective, but it also becomes more sensitive to external factors. And then the third scenario focuses on mass balancing rules. In our earlier assumptions, we considered a relatively favorable case in what is often referred to as a free allocation mass balancing. In this case, 1 unit of pyrolysis oil translates directly into 1 unit of recycled plastic. However, this assumption is increasingly being challenged. In some regions, particularly in Europe, we are seeing a shift towards stricter accounting rules. For example, the UK has already adopted fuels-exempt mass balancing, and the EU is moving in a similar direction. Fuel-exempt mass balancing places tighter constraints on how recycled content can be attributed, and thus it also limits the amount of premiums we can expect from pyrolysis oil as a recycled material. So in this scenario, we model a more conservative case. We assume that only about 50% of the pyrolysis oil can actually be counted towards recycled content, and the rest of our pyrolysis oil outputs will be treated as virgin naphtha. And what this means is that instead of 1 unit of pyrolysis oil producing 1 unit of recycled plastic, it now takes 2 units to achieve the same outcome. As such, it effectively halves the value that refiners can capture from replacing virgin naphtha with pyrolysis oil, and this is reflected in the reduced price that we can ask for the product. We also included some offsets from incentives such as extended producer responsibility bonuses, but overall, the net effect is still a significant reduction in pyrolysis oil prices compared with the previous recycled content mandate scenario. So when we run the model under these assumptions, the impact is quite clear. Fuels-exempt mass balancing is pretty much going to kill the investment case for plastic pyrolysis. Here we see the expected IRR drop by roughly half. So while the project may still generate positive returns, these returns is often no longer sufficient to justify the required level of capital investment. The impact of strict mass balancing on the investment case that we observed through our analysis also aligns with what we are seeing in the market today. Some major plastic pyrolysis operators are actually slowing or reconsidering the expansion plans in regions with stricter regulatory frameworks. Now, beyond these 3 core scenarios, there are of course other developments that we can consider. For example, we can look at regional cost differences. Building a plant in a lower cost region can reduce capex and opex significantly. Anecdotally, we can expect cost reductions of anywhere between 30% to 50% when compared with a similar plant in Europe. We can also consider variations in policy strength. For instance, a scenario where recycled content mandates result in a smaller premium of about 2 times that of virgin prices, rather than the more aggressive assumption that we used earlier. We can also include potential offsets from extended producer responsibility or other incentives that provide direct subsidies for the use of recycled materials. So when we bring all of that together, we can see that the conclusion becomes very clear, right? Product price, and by extension, policy, is the dominant driver of returns. It's more dominant than feedstock cost, more so than technology cost, and more so than operational improvements. It is pyrolysis oil pricing that ultimately determines whether the investment case works. And so clearly, the key question for decision makers considering an investment in plastic pyrolysis is not just whether the technology works, but also under what conditions can it create the value needed for an attractive return, and how confident are we that these conditions will actually materialize. So in our final section, we're going to discuss and look at what all of this means for decision making. And at this point, we are no longer just looking at the numbers. Right? We're looking at how our numbers align with our organization's risk appetite. For a large, well-established company with strong and stable profitability, the natural approach is often to be more conservative. There's less pressure to take on high-risk investments and more emphasis on protecting existing value. So in that context, the preference is typically for technologies that are lower risk, more mature, and more predictable. And from that perspective, plastic pyrolysis is unlikely going to be an attractive option. On the other hand, if you are a company that is under pressure to evolve, or if you're operating more like a venture investor, the situation might look a bit different. You may be more willing to take on greater risk in pursuit of a transformational opportunity or big payoff. But even in that case, the investment is effectively a big bet that strong recycled content mandates will be implemented and strictly enforced. We are also going to bet that mass balancing rules will remain favorable, because without these two conditions in place, we are unlikely to achieve the levels of return that would justify our investment. And finally, another question that often comes up is whether we can improve the investment case by reducing uncertainty. For example, we can do that through securing long-term offtake agreements at a favorable price or integrating upstream to guarantee feedstock supply. And the answer is yes, these actions do help. They reduce variability and they increase confidence in our projections. But there is a limit to what they can achieve. For plastic pyrolysis, even if we reduce risk, the generally low expected internal rate of return continues to make the investment case less than compelling. So stepping back and looking at the big picture, it is still largely the case that investing in plastic pyrolysis is not worth taking the risk today, as it was a decade ago. After assessing both the technical and commercial readiness of plastic pyrolysis and incorporating the key external factors through scenario building, the conclusion is quite clear that in most cases, the expected financial returns do not justify the level of risk involved. Now, of course, there are exceptions. There are different technologies, different cost structures, and different regional dynamics. But as a general benchmark, this is where things stand. And at the same time, this analysis also gives us some valuable insight into what actually matters the most. For example, we saw that reducing feedstock costs had a relatively limited impact on IRR. So the real priority when it comes to feedstock supply is not feedstock cost, but rather its availability. Because in order for any of these projections to hold, the plant needs to operate at full capacity. So the key question becomes, how much feedstock can we reliably secure, and not just how cheaply we can acquire it. Secondly, lowering technology costs is helpful, but it's not going to be the primary driver of your returns. Even when we model a substantial reduction, for example, in our case, a 30% decrease in both CapEx and OpEx, the impact on expected IRR is relatively limited. Lower upfront costs can improve project feasibility and they can make projects easier to justify from a capital allocation perspective, but they do not fundamentally change the long-term return profile. So cost reduction can be seen as a supporting factor. It should be seen as a supporting factor rather than the main lever for value creation. And the most important lever, as the analysis clearly shows, is product price. This is where the largest impact on returns comes from. And more importantly, there's also a lot more flexibility here. It is far more realistic to achieve a 2 or even 3 times premium on recycled products, particularly when it is driven by policy, than it is to achieve an equivalent reduction in technology cost. So when we're evaluating different opportunities, the focus should be on those that can deliver higher value outputs rather than simply minimizing cost. And now, before we close, I want to leave you with some food for thought. So far, we've focused primarily on financial returns, on IRR, on profitability and investment risk. But there may also be strategic value that is not fully captured in these metrics. For example, in regions that are heavily dependent on imported petrochemical feedstocks, supply disruptions can have significant economic and societal impacts. We're already seeing this today in parts of Asia, where supply shocks have led to high energy prices and disruptions to industrial activity. So in this context, technologies like plastic pyrolysis can provide an additional source of feedstock and improve supply chain resilience. While this value is quite difficult to quantify, it will still be an important consideration for the final investment decision. And going back to how we often describe advanced plastic recycling as being in a chicken and egg dilemma, I don't believe that that is still the case today. I would instead liken it to it being eggs in an incubator. Advanced plastic recycling certainly has the potential to grow into a new business opportunity in the circular economy of tomorrow. However, for the eggs to hatch, the conditions must be right. Today, we are fine-tuning these conditions, and based on current capacity growth trends, I think we are headed in the right direction. Now, not all eggs are the same, and they do not all hatch at the same time. So it will be on us to keep in mind the timing and the prevailing conditions when assessing the case for investing in advanced plastic recycling to pick the winners of the bunch. So to wrap up, let me leave you with three key takeaways. First, it is critical to be precise about how the technology is deployed, because context, including location, feedstock strategy, and regulatory environment, will determine which scenarios are most relevant. And they give us an idea of how we can de-risk if the uncertainty is too high. Secondly, high product prices, often driven by policy, are essential for making advanced recycling investments viable. And finally, while financial returns are important, they're not the only dimension of value. Strategic and systemic benefits may also play a role in value creation. And with that, I conclude my webinar. Thank you very much for your attention.
Great. Thanks so much, Martian. We will now be taking questions that you have on the presentation, which you can type into the questions box. If we do not get to your questions on this call, someone from Lux will be in touch after the webinar. Okay. So the first question, the projections for plastic pyrolysis don't have such a great outlook. Do you see in any way for the case for plastic pyrolysis to work out positively? Maybe if we were to adopt another technology, which is not as expensive.
Well, I think if you had the chance to assess a lower cost technology for investment, definitely go ahead, right? Tweak the parameters, see how it turns out for you in terms of both the risk and reward that you can get. But I think as our analysis showed, I think it's quite unlikely that just reducing technology cost alone is going to make the investment case any different from what we're already seeing today. However, I would say that based on what's happening today, one of the only ways for plastic pyrolysis to work is if we were to vertically integrate, right, all the way from feedstock collection and processing and all the way down to the refining and to the ultimately producing that recycled plastic for sale. And this is because at every step of the way, there has to be some margins to be made, right? If we were to kind of distribute all these activities to a third-party stakeholder, right? Your waste supplier needs to make a profit, your pyrolysis operator needs to make a profit, your refiner has to make a profit, right? And all these margins will add up. And we can see already today that with plastic pyrolysis itself, the margins may not be big enough to justify operating as a standalone recycler, as a standalone plastic pyrolysis operator. But if we were to vertically integrate though, right, now the way that you view plastic pyrolysis, you're no longer concerned about, say, the market price of pyrolysis oil, right? Instead, your concern rather than right now, your focus should be on production cost instead, because you're not looking to make that margin at the pyrolysis stage, but you're actually looking at margins across the whole process, right, all the way down to the actual plastic itself. So yeah, it might work. I think we're seeing this strategy happening with some of the bigger chemical corporates who are invested in plastic pyrolysis today. But as a standalone system, as a standalone activity, I think it's very difficult to see positive returns for plastic pyrolysis itself.
Great. So this next question is around timing. So, as you mentioned, as the circumstances change, we need to keep reassessing the business case. And, using plastic pyrolysis as an example, if we've decided that it's not worth investing in today, when would be a good time to take another look at the business case again? And how do you determine the best timing?
Yeah, well, this is a hard question. I mean, what I would do is to time my reassessments based on where I see the significant changes happening, right? And a lot of times this is going to be regulatory deadlines. So, for example, right, with the PPWR coming into effect sometime in 2030, right, sometime around 2027, 2028 will be a good time for you to make a reassessment because you need about 2-3 years to get your plants constructed and get up to speed, right? And so I would look for these markers based on regulatory deadlines as kind of an indication of when it is time to do a reassessment. So I think some of you probably here would argue that, hey, this is a bit passive, right? We're losing initiative. We're just going to wait for regulations to happen, right? But I would argue, right, that we don't really need to rush into investing in a full-scale commercial advanced recycling plant, right? And that is because the market for advanced recycling for plastics itself is huge. Last year, I think we consumed about 430 million tons of plastic. And if you were to assume that advanced recycling can address, say, about 10% of this overall global plastics consumption, we're talking about production capacities of about 40, 50 million tons a year, right? And this would mean that we need to build hundreds and hundreds of these advanced recycling plants to reach that level of production capacity. So granted, your first movers, your early movers will have first dibs at the market. I don't think there's going to be a situation where these early movers are going to scale up so quickly that they're just going to dominate the market and leaving no space for newer players and new entrants in advanced recycling and for producing these chemically recycled or advanced recycled plastics to feed the market demand. So I would say, right, you can be patient with kind of competing to your commercial production capacity, but in the meantime, definitely keep engaged with the technology, right? Keep engaged with technology developers, invest in interesting startups if they have high potential, right? Continue making your partnerships, being involved in collaboration so that you can stay agile and react to the need for advanced recycling capacity when the time is right. And again, I do think that these regulatory deadlines are going to be one of the biggest markers that you can use to time your reassessments.
Great. So I think we only have time for one more question, but I'm going to combine a couple of the questions I see here in the questions box into one kind of big final question, where I've known that you've done the same analysis for other technologies, like thermochemical depolymerization, solvolysis. And so the question I have, and that they have in the from the audience is, are there any of these other plastic recycling categories that are more, or that appear to be more financially viable? Or do you see similar results as the pyrolysis case? And also, were there any noticeable differences in levers or distinct opportunities for these other categories?
Yeah, I've definitely done assessments for the other categories of technologies, and I think one of the most interesting results is that the levers remain the same, right? Feedstock changes in feedstock prices did not really change the investment case, and a lot of the times for these technologies to be viable, you actually need to be supported by high recycled plastic prices, and often driven by regulatory requirements. In some cases, though, like PET policies, for example, the innovation maturity the innovation maturity is higher than plastic pyrolysis, and so the level of risk that you're working with may be a bit lower, and so the trade-off between risk and return kind of changes, where you do, on one hand you get very high risk, very high reward, for the case of when whether if the recycled content mandates come into play. On the other hand, right, if you do not assume that you're going to bet on this high recycled content prices, and you're just trying to match virgin plastic prices, the investment case still kind of works out. Yeah, even if your return on investment is not going to be the high 20-30%, right, it's still going to work out quite reasonably well. And I think that's also why we do see more successful commercial cases of PET chemical recycling than something like plastic pyrolysis or like waste to aromatics depolymerization.
Great. Well, thanks so much, Martian. That concludes our webinar for today. The slide presentation and recording from this webinar will be sent to all attendees. After leaving the webinar, you'll be prompted to complete a survey on today's presentation. We would very much appreciate any feedback that you have, because this helps to inform and improve future webinars. And also take a moment and check out our upcoming webinars on our website. Thanks for joining us, and have a great rest of your day.